Welcome to this explainer. Today, we are tackling a massive, recurring headache for non-resident Indians basically everywhere: how to actually keep the wealth you generate in India. If you're an NRI working hard abroad but maintaining investments back home, you already know the sting of seeing your returns shrink before they even hit your foreign bank account.
So, are you paying tax twice on the exact same income? It's a crucial question because earning interest, dividends, or rent in India often springs this really painful double tax trap when you file your returns back in your resident country. You earn it once, but the tax man comes knocking twice. It feels totally unfair, right? Well, there's actually a legal mechanism to stop it.
Here is our roadmap for today. We'll cover the double taxation problem, what the DTAA actually is, the two ways it works, the financial benefits, essential documents you'll need, and finally, claiming your tax relief.
Part 1. The double taxation problem and losing your hard-earned money. We really need to confront the main pain point here. If you just leave your NRO accounts unoptimized, you are automatically losing 30% right off the bat as tax deducted at source. And that happens before your resident country even takes a single look at it. Just think about that for a second. Nearly a third of your interest income just vanishes instantly. It's a massive leak in your financial bucket, and it happens by default unless you proactively stop it.
Which brings us to part 2. What is the DTAA, the shield for your wealth?
There's a hero in this story, and it's a legal framework explicitly designed to protect you from that exact 30% haircut. Think of the DTAA, the Double Taxation Avoidance Agreement, as a mutually agreed-upon rulebook between two governments. It decides who gets to tax your income, and by exactly how much. It's essentially a contract between India and your current home country that says, hey, let's be fair to this taxpayer so we don't punish them for investing across borders. And here's the best part. Whenever the DTAA offers a lower tax rate than India's domestic laws, the DTAA always wins.
And just to give you an idea of the sheer scale here, India has active DTAA treaties with over 90 countries. 90! That literally covers almost everywhere NRIs live and work, from the US, UK, and Canada to the UAE, Australia, and Germany. Chances are you are absolutely covered by one of these treaties right now.
All right, part 3. 2 ways the DTAA works: exemption versus tax credit.
So, we know the treaty exists, but how does this actually work to save you money? Well, governments generally apply 2 distinct mathematical methods, and it depends entirely on your resident country and the exact type of income you're generating. Under the exemption method, exclusive taxation rights go to just one country. Under the tax credit method, both countries keep the right to tax, but one gives you a credit for what you already paid the other. Let's look at some real-world examples to make this crystal clear. Take a fellow NRI, Yash, living in the UAE. Because the UAE basically has no personal income tax, the India-UAE treaty effectively uses the exemption method. So if Yash earns interest in India, India might tax it at a lower treaty rate, but the UAE exempts it entirely, meaning Yash pays absolutely zero tax in the UAE on that Indian-sourced interest. Pretty great, right?
But conversely, let's say Yash moves over to the US. Now we're looking at the tax credit method. India taxes his interest at a reduced treaty rate, let's say 10%. When Yash files his US taxes, he does have to declare that Indian income. However, the US grants him a 10% credit for the taxes he already paid to India. He only pays the US the difference if his US tax bracket happens to be higher. The key takeaway? He's never paying double.
Moving on to part 4, the financial benefits and keeping more of your money. Let's translate all this legal theory into actual tangible numbers for your portfolio. By utilizing the DTAA, you can slash that default 30% Indian TDS rate way down to 15%, 10%, or even 0%, depending on where you reside. If you're in the US or UK, your interest TDS drops to 15%. In the UAE, it can drop to 0. That is immediate, direct cash staying in your pocket instead of going to the tax department. And hey, remember, this treaty isn't just about bank interest. It shields dividends by capping the withholding tax. It drops TDS on royalties and technical fees to just 10 or 15%. It completely protects your foreign business income from Indian taxes as long as you don't have a permanent establishment in India. It even dictates capital gains rules, though you absolutely must verify your specific treaty for that one. For example, the famous Mauritius and Singapore routes for zero capital gains were amended back in 2016 and 2017, making shares acquired after April 2017 taxable in India. Part 5. Essential documents you need. The DTAA Treasure Map. Knowing about the DTA is amazing, but to unlock these massive savings, you need the right keys. Here is your exact checklist of documents to gather before you claim anything. You're going to need your PAN card, passport copy, visa or PIO proof, and an indemnity or self-declaration form. But really, the whole shebang revolves around the top 2 items on this list, the TRC and Form 10F.
Let me be absolutely clear about this. You cannot bypass the TRC. It's the ultimate proof, issued directly by the tax authority where you currently live, like the IRS in the US or HMRC in the UK, proving that you actually live and pay taxes there. You must obtain this, and you have to renew it every single year. Once you have it, you just pair it with Form 10F, which you can easily file online on the Indian Income Tax e-filing portal.
Which brings us to Part 6, claiming your tax relief, a simple process. We understand the math, we have the documents, so let's put it all into action. The process is actually pretty effortless if you follow these 3 chronological steps. First up, gather that TRC and file Form 10F. Crucially, submit these to your Indian income payer, like the bank holding your NRO account, or maybe a tenant paying you rent, before the income is paid out. This ensures the bank deducts the correct, lower rate from the very start. Finally, you just file your Indian ITR 2 to declare it all.
Now, what if you're watching this and thinking, oh no, my bank already took the full 30%? Well, don't panic. You haven't lost the money forever. You can still claim a refund during Stage 2. When you file your verified Indian tax return, you just show that the lower treaty rate applied, and the Income Tax Department will process a refund for the excess amount taken.
As we wrap this up, I really want you to internalize this. Using this framework is your legal right. It is absolutely not some shady loophole you're exploiting. It's a system built deliberately by governments around the world to encourage your cross-border investments and ensure that taxation is actually fair and equitable for global citizens like you. So, that leaves us with one final thought. Your specific financial situation, the country you live in, the exact mix of your assets, it's all completely unique to you. So use this explainer as your foundation. Take this knowledge, consult a chartered accountant who specializes in NRI taxation, and ask yourself, are you going to finally claim what's legally yours, or are you perfectly happy tipping the tax department 30% of your wealth?